So hi guys, welcome back to another YouTube video. All right, so I hope you all are all doing well. Okay, so today's topic of this video, we're going to be focusing on regearing and ungearing. Okay, regearing and ungearing, which is a bit of a complicated topic or complex topic. Most students feel that they struggle with this topic. Okay, they say, okay, this is difficult. I don't understand this. Okay, how do we do it? Okay, why is it so complicated? Maybe the formula looks a little bit tricky, looks a bit complicated. All right. So this is a topic which certain students struggle with. So therefore, I thought, okay, why not make a video and help you all, understand how this works. All right. So initially, let's start off by talking about certain terminologies, certain things which you all need to know before we start off with regearing and ungearing. In which scenario do we need to do regearing and ungearing? Right. So this is an area which is connected to syllabus area E. All right, which is business finance. Okay, so it's connected to business finance, also connected to your cost of capital calculation. All right. So now you all know, okay, the existing cost of capital of an organization, the existing weighted average cost of capital of the organization can be used to appraise a new project, can be used to appraise a new project under two scenarios. One, if the company's business risk remains the same. The second scenario is if the company's financial risk remains the same. All right. So if the company's business risk and if the company's financial risk are remaining the same or it's not changing, in such a scenario, we can use the company's existing WACC to appraise a new project. All right. But now let's assume either one of the two. Both can change at the same time, but let's assume one of the two is changing. If the company's business risk or if the company's financial risk is changing, that means the overall risk of the organization is changing. If the overall risk of the organization changes, then ideally the investors, either the equity holders, they will expect a different level of return, which will lead to a different bank. Therefore, we cannot use the company's existing weighted average cost of capital to appraise the new project. All right. So this regearing ungearing scenario is more so suitable if the company's business risk is changing. How do we calculate a new cost of equity for the organization? All right. So that is the bit of an introduction. All right. So as you all know, when you take the total risk of the organization, total risk. Let's assume this is the total risk of company X. So the total risk is a cup, all right? A very nice cup or glass or whatever you want to call it. So if you look at this cup includes the total risk of company X. So the total risk of company X will include two things. One is the business risk of company X and the other is the financial risk of company X. So when you say business risk of company X, I'm talking about the risk which arises due to the business operations, all right, or due to the industry which we are in. So if you are in different industries, for example, a company which is in the mining industry and a company which is in the education industry will have two extremely different levels of risk due to the business operations which they are undertaking. That is the business risk. Okay. On the other hand, financial risk is the risk which is arising due to the capital structure of the organization, which is the debt to equity ratio, the financial gearing. As you all know, if a company has a higher level of gearing, a higher proportionate of debt, a higher proportionate of long-term debt, that means its financial risk is higher. All right. So a company's total risk is a mix of two things, which is the business risk and the financial risk. Right. So now, if we say, let's say, company X is operating in the education industry. Which industry? Company X is operating in the education industry. Okay. Company X is operating in the education industry. Therefore, our business risk should be the risk of the education industry. Okay. and the financial risk will be the risk which is due to our capital structure. All right. So according to this level of what you call this level of risk, let's assume our cost of capital is calculated as 12%. Okay, fine. This is the existing scenario of the organization. Okay. So now let's assume Company X is getting tired of operating in the education industry. We are fed up of operating in the education industry. Done a lot of projects. We've made a lot of investments. We've opened a lot of colleges, schools, whatever. So we are kind of bored, all right? So education industry, we don't want to operate in the education industry anymore. Therefore, what is going to happen is company X is going to what? We are going to invest. We are going to invest in the what industry? A supermarket. Okay, we are going to invest into the supermarket industry. We are going to invest into the supermarket industry. All right. So now tell me the level of risk in the education industry and the level of risk in the supermarket industry, is it going to be the same or is it going to be different? It's obviously going to be different. All right. So now we are going to have a new project. Let's call it project Y. We're going to call it project Y. So we have a new project which is available, project Y. What are we going to do in project Y? We are going to invest into a new supermarket. All right. Now, can we use the company's existing cost of equity of 12% to appraise this new project? Can we? Can we use the existing cost of equity? No, we can't. Why cannot? Why can't we use the existing cost of equity? The reason being that okay, now the company's risk is going to change. There's going to be a change in the level of the risk. Okay. Now, if we are going to invest in the supermarket industry, if you look at the total risk level in the organization, total risk, what is going to happen is that the business risk, we have to take the business risk of the supermarket industry. We have to take the business risk of the supermarket industry along with our company's financial risk. All right. So the total risk of the organization is going to change. So that is what's going to happen. So now we can't use this existing risk level. What we need is operating in the if we are operating in the supermarket, right? This is what we need. This is what we require. This is what we have to calculate. We have to calculate. We have to identify what is the risk of company X in the supermarket industry. All right. All right. So this is a very important part. All right. So you have to remember our objective or what we are trying to calculate, what we are trying to identify, or what we are trying to find out is we are trying to find out what is the risk of company X, what is the risk of company X if we are operating in the supermarket industry. So you have to assume in regearing and ungearing, our financial risk is not changing, which is our capital structure is remaining the same. We are assuming our capital structure, financial risk remains the same, but our business risk is changing. In such a scenario, we will have to calculate what is the new cost of equity for the organization. Why? Now, if the level of risk is changing, ideally the level of return expected has to change. So we need to calculate what is this new level of return. How are we going to do that? All right. So that is a very good question, which we are going to learn. That is why I am here. So first things first, there is a couple of steps which you have to remember. There is a couple of steps which you have to remember. Couple of things which you have to remember actually. All right. So the first thing is now in order to find the total risk, if you in order to find the risk of company X in the supermarket industry, what do we have to do? We have to mix two things. We have to mix two things. We have to mix the business risk of the supermarket industry along with the financial risk of company X. All right. So out of these two things, we already have one. So we need two things. What do we need? The business risk of supermarket industry and the financial risk of company X, the capital structure. But we have one of these two things already with us. What do we have? We have the financial risk. Don't you know your own company's capital structure? Our company's capital structure? Company X capital structure? Does company X not know? Obviously, company X will know. Our capital structure is 40% equity, 60% debt. 70% equity, 30% it could be whatever. We would know that. So we would know what is the financial risk of the organization. What don't we know? We don't know what is the business risk of the supermarket industry. So now, first things first, we have to find out, we have to identify what is the business risk of the supermarket industry. So remember, step one in regearing, ungearing is to identify what we need to identify a proxy company. We need to identify a proxy company. We need to identify a proxy company. What is a proxy company? All right. A proxy company is a company which is having a similar business operation. All right. So now we are going to go into the supermarket industry. We have a new project, which is we are going to go into the supermarket industry. Okay. So if we are going to go into the supermarket industry, okay, we are going to do a project, we are going to make a supermarket, some sort of supermarket. I have no idea. Just assume, just imagine we are creating a supermarket. We are going to find a company which is already doing that type of business. All right. So let's assume we identify a proxy company which is company A. So company A is already operating, company is already operating in the which industry? Supermarket industry. They are running a chain of supermarkets, whatever. So they are in the supermarket industry for a period of time, and their business operations is similar to what we are going to do. So if you look at the total risk of company A, if we look at the total risk of company A, total risk of company A, you will have company A's business risk. So company A's business risk is the risk of what? Supermarket industry. Okay. And you will have company A's financial risk. All right. So the risk of company A's capital structure. This is the total risk of company A, the total risk of the proxy company. All right. So this total risk, guys, remember this, very important. The total risk of the organization, another word, another terminology which we use in this chapter is what we call it the equity beta. All right. We call it the what beta? Equity beta. I hope you all have a pretty good idea of what beta is. Beta means it's a measure of risk. Beta is a measure of risk. All right. You learn that in the CAPM model, capital asset pricing model. All right. So total risk is known as equity beta. It's known as another name for equity beta is geared beta. All right. Or share beta. All right. Different term, but in FM, financial management, we ACCA all right, we call it equity beta. All right. So total risk is known as equity beta. Now, what did I tell you all? What do we need? We need ideally in order to calculate what is company X risk in the supermarket industry, we have to mix two things. Business risk of supermarket industry, financial risk of company X. We have financial risk of company X. What do we need? We need the business risk of supermarket industry. We need to identify this. So what do we do? In this cup, we have two things, but one is not needed. What is the thing which we don't need? We don't need the financial risk of company. That is not relevant for us. We don't need that. We don't want that. So we have to remove it. We are going to take it out. So step two in regearing and ungearing is what? Ungear the proxies equity beta. Ungear the proxy company's equity beta. Ungear means remove the impact, remove the effect of gearing. Gearing meaning financial gearing. We are going to remove this financial gearing. We are going to remove this capital structure. So if you remove it, if you take it out, what is left? We are taking this financial gearing out. We are taking the financial risk out of the cup. What is left over inside the cup? Inside this cup, the business risk of the company A or the risk of the supermarket industry is remaining. All right. So when you have the business risk alone, when the business risk is only there, we call it what? The asset beta. We call it what? Beta. Asset beta. So asset beta is called as asset beta. It's called as ungeared beta also. So remember, CAPM. Don't forget, right? So business risk alone is known as asset beta. Okay. So now remember, if we want to calculate the risk of company X in the supermarket industry, we have to mix two things: business risk of supermarket industry and financial risk of company X. So in this cup, business risk of supermarket industry is there. Business risk of supermarket industry is there. But what is missing over here? The thing which is missing is financial risk is missing. All right, financial risk of company X is missing. So we are going to mix the financial risk over here. Okay. So step three is to what? Re-gear the asset beta. That is step three. So re-gear meaning we are going to introduce the impact of gearing, introduce the impact of financial risk. Therefore, for this cup, we are going to add, okay, business risk of company A or business risk of supermarket industry is there. We are going to add the impact of financial risk of company X. Re-gearing, right? So now in this cup, what do we have? We have the business risk of supermarket industry. We have the financial risk of company X. So in other words, we can call this cup the risk of company X in the supermarket industry. Yes or no? Of course, yes. Did we did we calculate what was required? Yes. What is the risk of company X in the supermarket industry? We found out the risk of company X in the supermarket industry. This is company X's new equity beta. So this new equity beta can be used in the capital asset pricing model to calculate the new cost of it. So with regards to regearing and ungearing, this is basically what we are going to explain. Very simple. All right. So this explanation, I hope it makes sense. If it really makes sense to you, that means the calculation is going to be really easy. All right. So now let's move on into the calculation, which is the main aspect. It's not enough. You just knowing, okay, you are mixing in a cup, business risk and financial risk. You can't go to the exam and write, okay, examiner, I'm going to mix some stuff in a cup and get the risk. No, we have to know how do we do the calculation, which is very important. So in order to understand that, let's look at a small example. Okay, let's look at an example. So company B, a training company. So company B is our company. So our company is in the training industry. Has a debt to equity ratio of 1 is to debt to equity ratio of 1 is to 2. So it wishes to expand into the recruitment consultancy industry, right? So we need to find out. Okay, so our company is going into a new industry, which is the recruitment consultancy industry. So we need to identify what is company B's risk in recruitment consulting industry. So I'm too lazy to write the entire thing, but you get the point. We need to calculate company B's risk in the recruitment consultancy industry. It has identified the beta of a highly geared recruitment consultancy company, company X. This is what? Company X is our proxy company. Okay. Is 1.8. This is its equity beta and is influenced by its high level of gearing of 1 is to 1 debt to equity. Assume that debt has a beta of 0. Risk-free rate is 4%, market rate is 12%, tax is 30%. Required, calculate the cost of equity that company B should use to appraise this investment. Right. So step 1, go back to step one. What is step one? As I said, step one, identify proxy company. We have the proxy company. Proxy company is company X. We know what is the proxy company's equity beta, and we know what is the proxy company's gearing debt to equity ratio. Step two, we have to ungear company X. We have to ungear the equity beta of the proxy company. And we have to arrive at the asset beta. How do we do this? Ungearing. So there is a small formula. I was joking, it's not small, it's quite big. As you can see, it's a quite big formula. It looks a bit scary, I know. The first time I was learning this, I was a bit scared. All right, but not to worry. So ACCA has simplified this formula a bit. So we assume that the debt beta here is zero. Therefore, this part of the formula is not relevant. Only the first part is relevant for us. Only the first part is relevant for us. All right. So this part of the formula is not needed. All right. So you don't have to memorize this entire formula, guys. Don't memorize it. Don't waste your time. It is in the formula sheet. So in the exam, you will get the formula sheet. In that formula sheet, you have this formula. So what is BE? This is the asset beta. What is BE? Value of equity. What is this? Value of debt. What is one? What is one? T is tax, the tax rate, and PE is the equity beta. All right, so that is the formula over there. So in the process of ungearing, we are removing the impact of gearing. Therefore, what we are trying to calculate is the asset beta. So the output of the ungearing process should be the asset beta. Therefore, you can calculate asset beta by using this formula. All right. So let's just use that formula. So asset beta equals to value of equity divided by value of equity plus value of debt into 1 minus t. Correct. So I got the formula correct into beta equity. Right. So one mistake which students generally make is that they use the incorrect value of equity and value of debt. They use the incorrect value of equity and the value of debt. Or in other words, they use the incorrect capital structure. All right. So in the process of ungearing, if we let's go back to the drawing, in the process of ungearing, guys, what are we doing? We are taking the proxy company's equity beta. We are taking the proxy company's equity beta and removing the financial risk. So if you are taking the proxy company's equity beta, ideally what you have to use is the proxy company's, you have to use the proxy company's capital structure. It might seem straightforward, but many students make this mistake. So in the question, we have two capital structures. We have the debt to equity ratio of our company. We have the debt to equity ratio of the proxy company. In the process of ungearing, we are ungearing the proxy company's equity beta. Therefore, what should we use? Proxy company's capital structure. Okay. So proxy company's capital structure is 1 is to 1 debt to equity. So what is the value of debt? Sorry, what's the value of equity? Equity is 1. Value of debt is also 1 into 1 minus the tax rate. Tax rate is given as 30%. So 1 minus 30% into beta equity. Into beta equity, which is again proxy company's equity beta is 1.8. So that will give you the asset beta. Okay. So that will give you the asset beta. So this is, forgot to mention it, step 1. So you all can take out your calculators and along with me, you all can quickly calculate what is the value of beta. All right. So if you calculate it, if you input these values into your calculator, you will get a value or you will get an answer of what is the answer you are getting? 1.06. The answer is 1.06. So if the answer is 1.06, what does it mean? This 1.06 is the asset. What is this? Is the asset beta of the proxy company. So we can say this is the risk of the which industry? This is the risk of the recruitment consultancy industry. This is the risk of the recruitment consultancy industry. Okay. So step two is that. What is step two? Ungear the proxy company's equity beta. So we have ungeared it. We have the asset beta. So in our cup, what is the only the business risk of the recruitment consultancy industry is there. Now the third step is what we have to regear. We have to regear this asset beta. We have to introduce the financial risk of our company into the asset beta. All right. So how do we do this? Step three. How do we do this? Step three, right? Regearing. So this should be step two ideally, not step one. My bad, right? Now, now guys, we have the asset beta. So we have the correct asset beta. We have the correct asset beta. Okay. We have the value of equity. Yes or no? We have a company's capital structure, value of debt is there, tax is there. What is the output we are trying to get in the process of regearing? The output which we are trying to get is the equity beta. So this is the unknown figure. So simply we have to rearrange the formula to calculate this beta equity. All right. So let me just copy this same formula over here. Same formula, right? My bad. Here. Sorry about that. Yeah, there we go. Same formula. So we know the asset beta figure is 1.06. Now, once again, don't make this silly mistake. When we are in the process of recurring, which capital structure should we use? We have to use our company's capital structure. This one is to 2. Debt to equity ratio of 1 is to 2. So value of equity is 2. Value of equity is 2. Value of debt is 1 into 1 minus 30% into beta equity, that is the unknown figure. Okay. Therefore, if we rearrange the formula, what are you getting? Beta equity equals 1.06 into 2 plus 1 into 1 minus 30% divided by. Therefore, if you solve this, what is the beta equity that you are getting? So, guys, you all also try to calculate and get the answer, right? So, the beta equity you will be getting is 1.43, right? So, what is this 1.43? This is the new equity beta. This is the new equity beta of our company. Or else we can say this is our company's risk in the recruitment consultancy industry. I hope this is clear. So now, simply what do we have to do? We need to calculate what is our company's new cost of equity. Step 4, calculate the cost of equity. So if we want to calculate the cost of equity, which method uses beta to calculate cost of equity? Which method connects risk and return? The method is the capital asset pricing model. So according to the capital asset pricing model, how do we calculate the cost of equity? That is the risk-free rate plus beta into market rate minus risk-free rate, or you can multiply by the risk premium. Same thing. So according to the example, what is the risk-free rate? The risk-free rate is 4%, market rate is 12%. So our equity beta over here, our new equity beta is 1.43 into market rate minus the risk-free rate. Therefore, what is our company's new cost of equity, or what is the cost of equity we have to use in appraising the new project? That is 15.44%. Right? So this is the new cost of equity. So this is the cost of equity to use to appraise the new project where our company is going to invest into the recruitment consultancy industry. All right. So again, pretty simple, right? Just a few steps. So I've written down the steps over here where you can, look at it. Step one, identify proxy company. Step two, ungear the proxy company's equity beta. Okay, in order to get the asset beta, in other words, in order to identify the business risk. Step three, regear the proxy's asset beta or regear that business risk using our company's capital structure in order to identify our new equity beta. And the final step, using this new equity beta, we have to calculate the company's cost of equity. So pretty straightforward, guys. It's not that complex. If you are finding it difficult, if you follow the steps, you can get it done. All right. So I hope that is clear, guys. Thanks for watching the video. I hope it was helpful. If it was helpful, make sure to like it and drop a comment. And if you all need any other explanation, if you want me to explain any particular topic, you can let me know in the comments. Thank you for watching.